Are you worried about what the economy has in store for us? Well, whatever storm comes our way, I have some total return stocks that are perfect for weathering the economy. Hold on to your seatbelts, folks. This is going to be a good one. Investing during turbulent economic times can definitely feel daunting. Of course, at the same time, it can also present unique opportunities. The uncertainty with the economy, well, that leads to some market volatilities, which can create opportunities to get some of our favorite stocks at a discount. You know who I'm talking about. Those are the folks who love to buy the dip. However, what if we are looking for stocks that have a better chance of simply surviving the rough weather? Those stocks do exist. And in fact, there are stocks out there that are still doing okay despite all of that volatility. The key to finding stocks like that are, well, good fundamentals, which honestly is never a bad thing when it is all smooth sailing as well. When you find a company with a proven track record and the math to deal with whatever is coming, those tend to be, well, some good stocks to focus your due diligence on for sure. As usual, I have done just that, and I have found 5 total return stocks that I do believe are worthy of your scrutiny. Speaking of total return stocks, a click on that sub button sets you up for more future returns of content like this. With this list I have for you today, I did, of course, have a few fundamental requirements that needed to be hit. First, I was not going to look at any stock without a return on equity of at least 15%. In addition to that, I also wanted their debt to equity to sit under 100%, as lower debt sure does give a company options when things go horribly wrong or even slightly wrong. I was also looking at companies with a value of at least $10 to avoid the penny and penny adjacent stocks. This did eliminate a few really good stocks, but we're taking the safety side this time around, so we're gonna lose some good ones along the way. I also wanted positive returns for the 3 years that I look at, so that 3-year, 1-year, and year-to-date time frames. So after all of that, after we sorted through all that math, I narrowed it down to 5, and we will present them today sorted by their year-to-date total returns. So without any further ado, let's do this. Kicking off this list, we have Canadian Natural Resources with a ticker of CNQ. They are based out of Calgary and are one of the largest independent oil and natural gas producers in the world. Their current price at time of recording comes in at $45.07. They've got a nice looking market cap of $71.02 billion. Their beta, 1.91. So they are almost twice as volatile as the market average. Their earnings per share, that's coming in at 2.60. Price to earnings ratio, 12.78. They have a return on equity of 19.65%. And that return on assets also looking pretty good at 8.80%. Looking at their debt to equity ratio, 29.64%. I definitely like that on this company. Switching to their dividends, their yield comes in at 4.659%. That's a quarterly dividend of 52.5 cents per share. That payout ratio, 56.90%. So they've got a pretty sustainable dividend, and I like that too. If we look at their returns, on their 3-year return on investment, that comes in at a nice looking 117.20%. That's not too shabby. Factor in the dividends, they get a total return of 170.16%. Switching to their 1 year, a little bit more moderate. That return on investment comes in at 3.75%. Add in those dividends, we get a total return of 10.89%. On their year to date, the return on investment, 3.61%. Total return, 10.74%. Without a doubt, they are a key player in the energy sector, particularly in oil sands and natural gas production. Even if oil struggles for a while, they do have the moat to easily weather whatever 2024 still has in store for us. Coming in at number 4, we have Computer Modeling Group with a ticker of CMG. They are based out of Calgary, and they provide reservoir simulation software to the oil and gas industry. This software, it's used effectively in the optimization of the entire extraction process. So if you're a little bit worried about tech, this one kind of more closely follows energy than tech. They have a current price of $11.67. Their market cap's coming in at $955.18 million. They're not that far off from being a $1 billion company. They have a beta of 1.23, earnings per share sitting at 0.28. Their price to earnings ratio, and it does reflect some of the growth we've seen with them, 41.68. So that is a little high. That return on equity, another really good looking number, 36.56%. Return on assets, 12.79%. Looking at their debt to equity ratio comes in at 52.77%. Switching over to their dividends, they don't have a big dividend. Their yield is 1.714%. It's a quarterly dividend of 5 cents per share. Their payout ratio, that comes in at 71.43%. Their 3-year return on investment, 149.36%. Factor in those dividends, we get a total return of 162.18%. On their 1 year, that return on investment comes in at 30.25%. Sprinkle in a few dividends, we get a total return of 32.48%. Year to date, their return on investment, 14.98%. Total return, 16.45%. Similar to CNQ, they are facing the same headwinds in regard to the reduced demand for oil. However, even in a reduced oil scenario, they still have a lot of value within the industry, and that could very well be an edge for them. Taking our third spot, we have Thomson Reuters Corporation with a ticker of RTI. They are based out of Toronto, and they are a multinational media conglomerate providing professional information services to the law, tax, compliance, and media sectors, just to name a few. Their current price, that comes in at $225.52. They have a market cap of $101.42 billion. This one's pretty stable. They've got a very nice looking beta of 0.40, making them more than half as less volatile as the market average. That's not too shabby. Their earnings per share come in at 6.97, and they have a PE ratio of 32.36. Their return on equity, 20.41%. That return on assets, 6.15%. Looking at debt to equity ratio, 29.05%. When we look at their dividends, they've got a yield of 1.323%. It's a quarterly dividend of 54 cents USD per share. Payout ratio on that, exactly 40%. Switching to their returns, on their 3-year return on investment, that comes in at 46.10%. Factor in the dividends, total return 50.30%. On their 1-year return on investment, that comes in at 28.95%. Add in those dividends, we get a total return of 30.06%. Year-to-date return on investment, 17%. After dividends, total return, 17.70%. This is a company that may even have a higher demand for their information service in, more volatile times. They are definitely a good total return safe bet for sure. In our almost top spot at number 2, we have Imperial Oil Limited with a ticker of IMO. They are based out of Calgary, and they are one of the largest integrated oil companies in Canada. At the time of recording, their price comes in at $92.28, and they have a market cap of $49.45 billion. Their beta, a little bit volatile, 1.80. Earnings per share come in at 9.54. Their price to earnings ratio, 9.67. They have a return on equity of 22.17%. Return on assets, 9.78%. When it comes to their debt to equity ratio, it's sitting at 18.27%. Looking at their dividends, they have a yield of 2.601%. Quarterly dividend, 60 cents a share. That payout ratio, that's coming in at 23.06%. Looking at their 3-year return on investment, That comes in at 173.75%. Total return, 189.97%. On their 1-year return on investment, that comes in at 17.26%. Factor in the dividends, total return 20.18%. On their year to date, that return on investment 21.17%. Dividends counted, we get a total return of 23.53%. From upstream to downstream, this is a company diversified into the whole process. And like CNQ, they have the moat to get them through whatever comes their way. In our top spot at number 1, we have Gildan Activewear with a ticker of GIL. They are based out of Montreal, and they are a leading manufacturer and marketer of basic apparel products. Their wares include activewear, socks, and underwear. At the time of recording, their price comes in at $59.70. They have a market cap of $9.71 billion. Their beta got a little bit of volatility there, 1.65. Earnings per share, 3.27. And they have a price to earnings ratio of 18.26. That return on equity, 21.95%. Return on assets, 9.32%. Looking at their debt to equity ratio, that comes in at 72.52%. They also have a dividend. Their yield comes in at 1.897%. It's a quarterly dividend of 20.5 cents USD per share. The payout ratio comes in at 32.31%, and like everybody else on today's list, their dividend very sustainable. Looking at their returns on their 3-year return on investment, that comes in at 27.29%. Factor in the dividends, total return 32.94%. On their 1-year return on investment, 54.34%, total return 56.85%. Looking at the year to date, their return on investment 37.24%, factor in the dividends, total return 38.41%. Holy banana bread. That's not too shabby when it comes to the type of year that we've been having, especially of late. They have strong manufacturing capabilities and a cost-effective production model, making them a key player in the global apparel market. Also, as long as dryers keep eating socks, the demand for new ones is not going to drop anytime soon. These 5 are interesting, and I feel any one of them could be a nice long-term play. I would love to check in with these guys early in 2025 and see just how well they have done. If you are interested in any of these stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on alternative assets, and I will see you in the next video.